Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Roni Israelov. He's the President and Chief Investment Officer at Endeavor to discuss portfolio diversification, why you need at least 200 stocks to make sure it is properly diversified. Roni, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me here, Jill.
Explain to us why true diversification comes at 200 stocks.
Yeah, so I think many people who have looked at diversification and how many stocks you should own is a popular question to ask, have actually come to a conclusion that 20 to 30, maybe even 40 stocks is appropriate. Our research shows something very different. Now, I think when people look at how many stocks you need, they often measure portfolio risk using a measure such as volatility. How variable are the day-to-day returns or monthly returns? And when you look at it in that context, you do arrive at a conclusion that 20 or 30 stocks may be sufficient, as many people have. But we thought that there's something else that really matters for investors. And investors, I mean, of course, they're concerned about the day-to-day volatility of their portfolio, but they're also concerned about the long-term volatility of the portfolio. You know, if their investment is intended to last, 10, 20, or 30 years, how much end wealth they have, how much variability in end wealth they have matters a great deal. So we revisited this question of how many stocks you need to own in order to reduce the risk of shortfall, but from the context of variability of end wealth rather than from the context of day-to-day volatility. And when you look at it from that point of view, you actually draw a very different conclusion. And if you look at portfolios of maybe 20 or 30 stocks that appear to be well diversified, in terms of their daily volatility, you still see considerable dispersion and outcome over a 20 or 25-year holding period. If we re-ask the question, how many stocks do you need to own from the point of view of variability of end wealth over an extended holding period, you come to a very different conclusion, which is 200 stocks or more.
Mm-hmm. So how would you pick 200 stocks? Is there a methodology behind that as well?
I think it depends on the underlying objective of the investor. If they are seeking a more passive-oriented portfolio, then it would be natural to focus on the largest market cap stocks, as an example, and focus their attention on that. If they're seeking instead perhaps to enhance the return properties of the portfolio, perhaps by adding a factor tilt, maybe allocating to momentum or quality, then they would seek out the 200 stocks or thereabouts that are more consistent, with that underlying tilt. And there are different forms of portfolio enhancement. Some people might be seeking to enhance the expected return, so they're looking for factors that predict, or characteristics that predict some stocks have higher returns than others. Others might be looking for a more defensive posture, so they might instead seek those stocks that have low equity beta or low volatility in order to have an overall portfolio that is not only highly diversified, but also has lower equity beta, lower volatility, so provides a more defensive, tilt to markets.
It's interesting. We've had a number of managers come on talking more about factor selection versus bottoms-up analysis to kind of remove some of that volatility from it, whether it's looking at the balance sheet for certain factors or, to your point, different volatility models. Let's talk about the inverted yield curve. We hear about that a lot. It's almost like we keep expecting this recession that has yet to materialize. Why is the market focused on this inverted yield curve?
Well, I think people are anxious, and
right.
it's natural to be anxious when something is uncommon. We looked at yield curves over the past 100 years, and when you look over the past 100 years, what you see is, about 10% of the time they're inverted, and rarely are they as inverted as they are today. Of course, a lot of people have focused on what an inverted yield curve might say about the economy going forward. Does it say we're going to have a recession? Does it say, something about inflation? And I think those are really interesting questions. We wanted to focus on something else that we think is important to investors, and that is, what does an inverted yield curve say about bond markets going forward, right? I mean, of course it's important to understand about inflation and, and employment and whatnot, but investors also care about their returns and, what's happening in their portfolios. So we decided to take a look at what inverted yield curves actually say about, about bond markets. I'm happy to expand on that.
Yeah, no, definitely, because I feel as if the equity and bond markets are thinking very differently when it comes in terms of an expected recession or where we are with interest rates and the impact of inflation. They seem to be trading on two very different narratives.
Yeah, and they're two different asset classes. So when we look at bond markets, and if we go back in time and look, historically at the last 100 years of data, and we focus our attention on those 10% of observations, in which case the yield curve was inverted historically, the first question we wanted to answer was, how do bond markets renormalize? Our expectation is at some point they'll renormalize to a non-inverted yield curve. Whether that's a year in the future or 2 years in the future, harder to predict. But there's a point in time in the future where bond markets will no longer see an inverted yield curve. And what does history tell us about how that tends to occur? Well, if we look at those periods where yield curves were inverted in the past, most of the time and most of the renormalization occurs at the front end of the curve. Roughly 4 out of 5 instances, we saw T-bill yields decline. If you look at intermediate bonds, bonds or long-term bonds, it was basically a coin toss. If you look at historical periods, half the time yields increased, half the time they decreased. So on average, you actually didn't see much movement in 10-year yields. You do see a little bit more volatility, which makes sense. There's more uncertainty in the market. So you see bond yields tend to be a little bit more variable in those periods, and bond returns tend to be a little bit more variable. But most of the renormalization, it turns out, occurs from the front end of the curve.
So it sounds like the work that you're doing at Endeavor removes a lot of this emotion and conjecture from the market when you're doing your portfolio selection.
Yes, we're very focused on data analysis and
Right.
research. So, we want to make decisions that are based off of data and economic theory. So when we're making those types of decisions, we're going to always kind of look to this type of analysis to help answer questions. I mean, if we go back to why people are so interested in the inverted yield curve, there's a lot of anxiety. What does this mean for my bond portfolio? What does this mean for bond returns? And should I change my asset allocation as a result of this? And we wanted to see what data had to say about that.
Yeah, all right. We appreciate the insight, Roni. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.